Hey everyone, I wanted to talk about looking at static pool returns for the S&P 500 and how we can download data from Yahoo Finance and we can look at those static pools of returns and get an idea of historically, one, how long do you need to hold an equity for it to approach consistently the average, and then two, if we were to invest in times that, let's say in a recession, what is the premium that you're going to have over a normal quote-unquote time frame. So what I've done here is I've pulled the S&P 500 data list from Yahoo Finance. I like Yahoo not any particular than any others, except that it's easy to pull data from, and since I'm an Excel geek, I like to run my own numbers. So the first thing we need to do is assign how old the static pool is. In this case, I like to just type in 1 and then +2 function to where I can just copy this all the way up. This is necessary to calculate yield. So now we type in a rate or a rate calculator function, and then we grab the number of periods that we just had. The payment is going to be 0. Then we're going to have a negative present value, then a future value. We grab the absolute, and then we multiply by 12. So notice that after 1 month the value is the same, so we have a 0% return. But if we take that all the way back to 1927, you're going to see an array of returns. And notice as we scroll up, all the numbers become a little bit more static towards that 6-7%. So what does this really mean? Well, let's graph it out. We want to insert. Recommended charts just makes it easy. Hit OK. And then let's grab the actual return that we want to see and let's exclude the last month. But keep in mind that these are annualized, and since we just had a market rebound in the last month, you're going to see one heavy spike towards the end. So it's really a good idea to change your axis to probably a 20% max, because the majority of those are going to fall within that range. Hit enter. And now let's look again. Let's blow this up so it's a little bit easier to see. Notice for literally decades, the annualized yield, if you were to hold it till this date, was almost exactly the same. That's why people, when they say, well, if you just invest in an S&P index fund, you're going to return about somewhere between 7 and 8% plus dividends, which is true. Notice that in times where the market was historically overpriced during the dot-com bubble, those static pools are going to return about 3 to 4%. Notice that there's volatility, that if the market's gone down since the end of last year, that these later static pools are sometimes going to be erratic. They're going to be nominal or even negative in this case. This helps me to look at valuations of equities in a little bit different manner. If you were to look at a cumulative yield, your graph is going to go all over the place just based on what the value is, because you're trying to say, what was my yield at any given point in time? Not necessarily say, if I bought at any given time, what would my yield be now? Which is a better example of how most people invest, since they're only going to really worry about what the value is at one point, which is retirement. So let's copy this. And let's look at this data another way. If I wanted to see what a static pool looked like over time, you would want to look at the cumulative return. So it's essentially just going in the reverse order. So now we grab that, carry it all the way down, and then we're going to do the same rate function. A little bit different. Rate, number of periods, payment's still going to be 0, negative, adjusted, close, with your absolutes now, because you're going to look at one point with cumulative return, not necessarily looking at what the term changes. And then we're going to grab the same cell and leave it open and multiply by 12. Let's change that. And I reckon we can move this over since that'll be in the right column. Notice how I use a little shortcut trick here to help me out, to where I can grab the bottom of a certain table and then throw an X in there. That's just a placeholder to where I can go back up, grab the formula, and it goes all the way down where I need it to be. So if you want to look at the cumulative return, grab the same data set, insert, recommended charts. Let's just use the first one. And again, we'll have what we thought it would look like. So what's happening is investors, when they're looking at their returns, let's say they bought in 1927 during the euphoria, and then they saw their investments crash to a negative 30%. That's really hard to swallow. Some people may get scared and start to liquidate there when it would be literally the worst time ever to sell. Now, unfortunately, some people don't have 20 plus years to where they can ride out the storm, and I understand they have to liquidate what they have to sell. But if you're able to hold the equity long enough, notice over time that return stabilizes to the historic mean, and to where even when you're buying at the peak of the market versus the bottom of the market, those compounded returns are not going to be very different. So I encourage all investors to not only look at the portfolio when they're changing and when you've bought it and what the value is at any given time. What you need to do is look at, well, how can I mitigate all the downside, i.e. buying at a rough time, to where I can dollar cost average, buy equities, and hold them to a certain amount of time to where I can get my anticipated return. And I would argue that if you hold most equities at least 15 years, outside of maybe .com era equities, that you're going to approach those average valuations. I hope this helps. If you like the content, please like and subscribe. Thank you.